Well, look, I think the thing that you want to feel today, to be out of the market, would feel so good. And yet, if you felt that way and you never reinvested at the bottom of 2009, if you were in cash, every single asset class outperformed you. So you've got to put this into a little bit of perspective.
Even a couple years ago, we had a 10% correction. And when we were down 10, it was very difficult to buy because you think you're going down 20.
2016 was very severe, and January through March, and here we made new highs.
Yeah.
I don't think that an economic downturn is imminent in the United States, but as Peter has said before, this is an older expansion with a tighter and tighter Fed. And this is going to matter, and there are other asset classes that we need to look at too.
Do you think we need to see anything in the underlying economy or in corporate earnings that sort of show why this happened, or could things be steady as she goes in both of those things, the economy, and still technically the stock market goes down for whatever reason, sentiment or for whatever? Is there something necessarily wrong with the underlying economy?
No, I don't think that there's something necessarily wrong in the sense that we have a higher hurdle now. Treasury yields across the curve, average 3%. You could get into high-quality municipal bonds without taking a long duration back and get a 6% taxable equivalent yield. This is a higher hurdle, and that's going to matter. In the end, though, I do think that you're going to get a very strong earnings season. Unlike the February-March period, we don't have a new trade war. We have the existing trade war. I think corporate confidence is telling us that there is going to be, of course, these pre-announcements, but in the end, that we're not going to completely derail this downturn. In a couple days' time, you won't see this correlation spike across every single market, right, and you start to repair.
Steve, are you're in charge of like asset allocation? I don't. No, normally it's so easy. It's like, I'm 60-40, but you really have to. You have to say something today. What do you tell clients? Should they be lightening up on stocks and going into bonds?
No, today is a good day to take a breath. I think when you look at what's going on, 325 on the 10-year is not a dangerous level. What's concerning to the market is that we went from 305 to 325 in the space of 3 days. And the market's going to take a break when that happens. But is it justified? Has inflation spiked since a week ago? No. Wages were growing this year. We started the year growing 2.7% year over year. We were at a whopping 2.8 in the last jobs report. We still have a core PCE that's right at the Fed's target. And while I know that there's some concerns that Powell's comments have signified a more aggressive Fed, we don't think it's the case. You still have 3 dots in that dot plot next year, and we're not sure they're going to achieve those 3. I think it's time to take a breath, and we'd be more inclined to buy here than sell. We think this has gotten overdone on both the bond and the stock side.
Boockvar, would you be surprised to see us breach 3% again, heading south? Yeah.
I would, but that means that the stock market would probably be lower.
Right.
So historically, the 10 years old where nominal GDP is. Nominal GDP is running 5-6%. The 10 years only 3.25%. And we also have to look at longer-term interest rates, not in the context of what's going on in the U.S., but Japan is letting long-term rates rise. The ECB is ending QE, so rates are going to rise there. So we're going to see a rise in interest rates just in response to the rise in rates overseas. So the rise in rates here is a confluence of factors with growth and inflation, just 2 of them.